and welcome to the Money Show. Your financial journey becomes clearer, smarter, and more empowering every single week. I'm Kavita Thapliyal, and whether you are just starting out with your first budget, navigating the world of investments, or planning for that dream retirement, this is the place to be where we break down complex money topics into simple, actionable steps. No jargon, no fluff, just real advice you can use to build wealth, avoid debt, and live that life you want. From saving hacks and credit tips to insider insights on stocks, crypto, and everything in between, we are diving deep, asking the tough questions, and bringing experts right to your ears. So get ready to take control of your financial future, boost your confidence, and turn money stress into money success. Because here on the Money Show, your money matters, and we are here to help you make every penny count. This show also answers your portfolio queries. So just in case you have anything that you want to send across in terms of your portfolio details, you can WhatsApp us your questions on 865-797-4571. You can also email us your questions on the money show at etnow.tv. That's the email ID for you. Alright, so let's begin the show. And over the past year, China-focused mutual funds have delivered jaw-dropping returns, some soaring as high as 53%. Now leading the pack is Mira Asset Hang Seng Tech ETF, which alone has surged 53.3% in just 12 months, ending June 2025. Now other China-based schemes have also posted impressive double-digit gains, significantly outpacing both Indian and global indices during the same period. Now this dramatic rebound comes as something of a surprise. Just a year or two ago, many global investors had turned their backs on Chinese equities, citing concern over a slowing economy, regulatory crackdowns, and tech giants, and geopolitical tensions with the West. However, recent policy support from the Chinese government, coupled with the modest economic recovery and attractive valuation, has helped reignite investor interest in the world's second largest economy. Now, Chinese tech and consumer discretionary sectors in particular have led this resurgence. From Indian investors, if we talk about them, these developments raise a crucial question. Now, is now the right time to look at East and diversify into China-focused funds, with India's own equity markets trading near all-time high and valuations appearing stretched? China may seem like a contrarian but potentially rewarding bet. Yet the risk remains substantial, from regulatory overhangs and structural economic shifts to currency volatility and political uncertainty. We'll explore what's fueling the rally in Chinese funds, how these instruments work, and what risks they carry, and whether they deserve a place in your diversified portfolio in 2025 and beyond. And most important, how do you get that exposure? I have with me Siddharth Srivastava, Head ETF Products and Fund Manager, Mira Asset Investment Managers. I also have Tarun Virani, Founder and CEO, TBNG Capital Advisor. Hi, good evening and welcome both of you. Siddharth, I'll come to you first because 53% in last 12 months. What drove this kind of return? 1 year gain, if we look at in Chinese focused funds like Mira Asset Hang Seng Tech ETF, how unique is this rally? What and how would you like to explain this?
Yeah, so first of all, thank you for having me on the show. So the Chinese equity markets have been depressed since quite a long time. They hit the Hang Seng Tech, which you're talking about, hit all-time high around late 2021, and since then it had gotten down quite a lot. So much so that Chinese equity started trading at a very sorts of attractive multiples. For example, MSCI China, which had a high PE of around 22 in Jan 2021, was trading at a single digit PE of 9.17 in September 2024. So there was a huge correction in Chinese market across tech also especially, and which made sort of China very lucrative, especially when all the global markets like US, Japan, etc. were trading at high multiples. Second, also the fact that there was a significant policy support by PBOC, which sorts of provided some comfort to the market. The Chinese government is finally waking up and providing support not only to property but also to local governments, and was trying to boost domestic consumption. That also sorts of help build confidence. And second and thirdly, the earnings in tech segment sorts of never got depressed. For example, the EPS more than doubled from 2022 to 20 June 25, from 131 to 267, whereas price only rose by 28%. So tech sorts of emerged as an attractive avenue within the Chinese ecosystem, and that is why we are seeing that because of all these reasons, investors have gone back and invested in Chinese market, which have seen almost 50 plus return in last 1 year.
Explain. And Tarun, here comes your role, because now I want you to analyze the difference in the returns. Now, that Mira Assets Hang Seng Tech ETF generated 53.3 returns. Nippon's India's Hang Seng Bees delivered 43.4%, contributed to the outer performance. Obviously, we know these are top heavy towards large tech giants like Tencent, Alibaba, NJ.com, etc. But why did other funds such as Edelweiss, Greater China Equity Offshore, 19.9% return if I'm talking about, Axis Greater China Equity Fund of Fund 17.2, lag behind these tech-focused ETFs? Are we looking at broader geographic and sector diversification, which maybe pull the performance down, exposure to property, financials, and Taiwan's exposure, making them less sensitive to a tech-led rally? Can we look at it that way, Tarun? What will you say?
So, good evening, Kavita. I think to your question, why this fund has given higher return, why this fund has given lower return, every fund has a different objective, right? And based on the objective, this some funds may have an objective to invest into high growth sectors, and some and which are marked to those indices. That's why they have delivered that kind of return. And some funds may have a very different mandate. So I think it would be very difficult to pinpoint on that part. But I feel what is more important is suitability. What is suitable for the client, that need to be defined very clearly, and based on that, allocation to that investment need to be planned. And I think China definitely brings a very different correlation to the markets like India. And I think we Indians have been investing largely India centric investment, and due to which I see which brings a lot of risk to the investors. So it is very important we start diversifying geographically, at least 10 to 15% of our portfolio. And to that thing, I think some part can be looked into emerging market like China. So from that point of view, it is a great opportunity, because last 4 year returns of the market as well as the price earning ratio of the markets are depressed, which gives a lot of margin of safety to investors. Last 25 years have been very bad for Chinese market. They are actually flat in 25 years. So anything which is so depressed, I think it makes a lot of sense for, and again, a market like which offers a 10% consumption growth from last 10, 15, 20 years. It's a great and good thing for value investors
Right.
who have a risk appetite.
Right. I really want to get into the policy and the macros of this with Siddharth. But before I go to Siddharth, one more question to you, Tarun. Now, let's talk about long term versus short term over here. While 1 year returns look stellar, 3 year CAGR from China funds is much more lower and in single digit. Now, from an investor's perspective, how should an investor balance short term highs with long-term volatility? Also, we are looking at returns in 2021, 23 were poor due to property slump and then COVID lockdowns, export slowdowns. Is it wise to chase these high short-term returns, or is a disciplined long-term investment approach more prudent when considering China, with periods where you will see aggressive downturn as well?
Right. So I'm a very strong believer of building frameworks before investing. I think you need to have a very clear framework why you are investing, right? When your why part is very clear, if you are investing in equity and investing into a equity like a high risk emerging market like China, or developed market like China, you would always like to keep uh, a long term horizon, right? 5 years, 7 years should be a minimum horizon investor need to look at before investing into a market like that. So from that point of view, any investor who is looking at investing into such kind of funds need to have a long horizon, because entire cycle needs 5 to 6 years to play out. Give you a very deceptive picture, and past return always gives you a very different picture, and your decision to invest should not be based on past. It should be based on the future value what you see in the market, and that should be based on the current valuation matrix, which currently continues to look attractive for any investor who has a risk appetite and has a 5 to 7 year horizon.
Siddharth, with you, I really want to focus on the policy and macro consideration, because being a fund manager, you really have to take all these things under consideration. Now, how significant were China's central bank and regulator led stimulus efforts in supporting the market rebound? Now, are these policy moves sustainable? Could further economic headwinds such as property sector stress, political tensions, or global trade slowdowns reverse the current uptrend also? How are you analyzing and factoring all of these things now?
PBOC and Chinese government measures were much required for the market. They started late last year, and they have been supportive, but they are sorts of targeted liquidity interventions. They haven't come out with a bazooka, which market was expecting, and that's why I think. Multiple times market response has been relatively sorts of muted whenever the policy announcements or supports, fiscal supports, etc., were announced, because markets have been expecting more and more. But having said that, they have lowered the mortgage rate, they have done repo rate cards policy, reduced the policy rates, they have sorts of supplementary lending reactivation to support local government financing, which apart from property markets were significantly stressed. They have sorts of supported state owned enterprises to purchase inventory to revive the property market. They have provided credit support to boost project completion. They have sorts of focus on reducing financial stress on local government bodies. So most of it has been to infuse liquidity into the system, to revive domestic consumption, to provide sorts of revive the property market, because as we know that property alone contribute almost 25% of China's GDP, which is significant, right? And that has been an overhang and continues to remain overhang. For example, while we have been talking about all this stimulus, property investment in China fell almost 10% in first half of this year, suggesting that sector is still not out of woods despite mounting policy support. Even the new construction starts have fallen significantly. So stress remains across. In fact, one more significant worry is around deflation. China CPI is right now just turned positive 0.1%, but if you look at producers inflation index, that is still in the negative territory. So deflation remains a concern, domestic consumption remains a concern. What has aided China in the first half was surprisingly front ending of exports, that we have seen more and more exports going out to Asian economies. Sorts of Chinese exports are currently using other countries to route their exports to US, and we have seen, in fact, a rise in exports by almost 5.8% in first half of 2025,
Right.
which has sorts of provided the GDP support also, which has come out more than the market
Sure.
expectations.
Sure, sure. So in this scenario, Tarun, now I know you said that you believe in a framework approach. Now, should investors prefer sector-specific ETFs like tech or diversified China, Taiwan, HKFOFs, or how should they balance out risk and return now?
So I feel China is a more of a consumption story, and I would always look at consumption as my top preference while investing in this market, because that continue almost a 140 crore kind of population, similar like India. I think China offers still a very large market with a 4x more, 5x more per capita income, right? So that the purchasing power is huge out there. So consumption continues to be my top sector pick in China. But I would strongly recommend to look at diversified fund rather than stock specific fund, because I feel that it gives much more diversification to the investor in case of any risk or anything. Apart from that, it again depends on the kind of investor and the suitability we are looking at. Investor who are more savvy can always look at all these EV, tech, and all these high risk sectors. But investors who are first time into the markets, my suggestion would be to look at more diversified ETF and plain vanilla ETFs in this market, rather than venturing into any stock sector specific funds.
We'll get on the part where we would like our viewers to know how can they have this exposure. But before that, Siddharth, what monitoring measures or exit triggers should investors set when holding China-focused funds given the volatility and macro risk?
First of all, investors should understand that they should view investment in China completely different to how they view investment in, let's say, US. I think US can form part of every investor's portfolio. It has sorts of more familiarity and more opportunity set. And I think if you have a reasonable risk profile, you can have, let's say, a 15% even exposure, 20% exposure to US markets. But but with China, you have to play safe because the biggest issue with China is the political risk and geopolitical risk, right? And how much so ever you analyze the corporate earnings, etc., the government policies can significantly affect the outlook on the market and your fund performance, like how it happened in 2021, 2022, when policy overhang sorts of battered the tech stocks, and the then late reopening of the economy battered the markets in general. So here you have to play tactically. I think you have to sort of look at lower valuations and take a much more informed call. I think you have to be aware that you're entering markets at the right level, and then perhaps exit when your target P levels are met. So I'll approach investment in China in a much more tactical manner than US, where sorts of I can invest and forget it about for 5, 7, 10 years or so.
Right. Tarun, what's the route that you would recommend now? How can they invest? I mean, while mutual funds, definitely there's a capping issue going on, but then LRS, investment in phased manner, lump sum, how can one go about it?
Yeah, so I think these are two, three routes available for any investor looking at participating in Chinese market. So A is Chinese focused ETF. Then you can get into direct stock trading into Chinese stocks also. But again, that all depends on your suitability level. If you are a savvy investor or you are a first time investor, it all depends on your risk appetite, right? So that need to be considered before looking at that market. Again, deployment plan can be based on what kind of time horizon one can look at. In this current scenario, I would recommend to go in a staggered way. Maybe not the way staggered it should be in India, but maybe much lesser staggered, because the market continues to offer a lot of value there. So that could be one approach one can look at.
Right. Last take from you, Siddharth, on how would you advise our investors to participate in this?
Yeah, first of all, investors, uh, whosoever has a higher risk appetite, should only look to invest in China. The quantum of money which you are spending or investing in China should be lower, in low single digits, and it should be, you should be willing to whether the drawdowns in the portfolio, because we don't know next 3 months, 6 months how geopolitical risk may play out. But like mentioned already on the show, that earning multiples are still attractive, but we also have to sort of see that despite 58% rally which has happened in Hang Seng Tech or so, it is still down almost 50% from its all-time high which it hit in 2021. So if you are comparing the highs in 2021 to right now, it's still available at a discount. You can look at that way, but you can also look at the fact that the Chinese market has still not recovered despite uh, positive voices in last 3 6 months, especially around the tech segment. So play it wisely, invest smaller portfolio, be ready to weather the drawdowns,
Right.
and yeah, have some patience for valuations and
Sure.
returns to come.
All
Yeah.
right, a tactical position, but then yeah, definitely not a part of your core portfolio. You know, you can, for diversification, satellite portfolio, the strategy can be opted for. Thank you so much, Tarun and Siddharth, for being on the show and helping our viewers strategize their allocation in the Chinese market today. Thanks.